Good evening, everyone, and welcome to the conference call to discuss the results for the quarter and 9 months ended 31st December 2023. Thank you for joining us today. We'll run through the presentation quickly, and then we'll throw the floor open for questions, and we'll always be happy to discuss. As always, we'll be happy to discuss any questions you may have on our business. Customary disclaimers aside, we don't know what the market is going to do. We are not giving earnings guidance, so please keep that in mind. Highlights: we had a net profit of 538 crores on a consolidated basis. Our consolidated NAV has moved up past 1,300 rupees per share as of 31st December. And we declared the third interim dividend of 6.30 rupees per share for Q3. Therefore, taking the total dividend for 9 months to 25.5 rupees per share. This is the 8th consecutive quarter of dividend payments that we're doing. Looking at the results, and let's go to the normalized numbers, and you know what the normalized means, where we strip out the effect of derivatives and currency. So we had a standalone net profit of 514 crores in the quarter, as opposed to 605 crores in the corresponding quarter of the previous year. Tanker markets were significantly weaker than in the previous year, and therefore the results were a little bit worse. This was offset by higher treasury income, etc. But the main story is that tanker markets were not as strong as they were in the previous year, October to December. That's October to December 2022. Coming to consolidated, again, the same thing is translated more or less into the consolidated numbers as well. We have a drop from 640 crores to 552 crores of last year to 552 crores of this year. And you can see for the 9 months as well that we are a little bit weaker than in the previous year. Again, we've seen, I mentioned the net asset value on a consolidated basis. On a standalone basis, net asset value was assessed at 1,068 rupees per share. These are the key ratios. I won't dwell too much on them. This is what I was mentioning. So we had $60,000 a day average earnings TC-wise for the crude carriers, which came down to just about $45,000 a day in October to December 2023. Product tankers also were much weaker, from $36,000 a day to $28,000 a day. LPG carriers, we had one repricing, which took the rate up slightly, the average rate up slightly. All of our LPG carriers are on the time charter market, are engaged in time charters. Dry bulk, we had slightly weaker earnings than in the corresponding quarter. However, in relation to the immediately preceding quarter, earnings were a little bit better. Crude tankers 45 versus 40. Product tankers, marginal improvement by about $1,000 a day. Dry bulk, a significant improvement because we had a very strong December. I think late November to mid-December was a very strong period especially for the Capesize. Coming to what contributed to our net asset value, and lest you think that this is only coming about by the change in the values of the ships, that's a very small contributor. So in the last 12 months, between December 22 and December 23, we've had an increase from 892 to 1,068. And the minus 35 is a dividend paid out. So 1,068 is despite paying out 35 rupees of dividend. A large contributor is 188 rupees of cash profit. So that's actual cash accrual to the company. A small part is from the fleet value increases, which is 24. So that's something to keep in mind, that a large part of the improvement in the value has come from cash flows. This is the 5-year movement. In March 18, we were at 357 rupees a share. Now we are just about 3x of that, which is 1,068 rupees per share. This is not taking into account the dividends which have been paid in the interim. Similarly, for the consolidated NAV, we moved from just under 1050 rupees per share to 1,300, where 88 rupees per share has come from the appreciation in the value of the assets. This is because the offshore assets have moved up significantly in value during this period. But 220 rupees has come from actual cash profits. Coming to what happened in the shipping market, first let's look at the tankers. Both crude and product tankers, on a 9-month basis, the crude tankers have been more or less the same as they were in 9 months of FY23. So about $51,000-52,000 a day. This is just the Suezmax that I'm talking about. They took some time to pick up after the war started. So you can see the orange line actually went down in May, June. It wasn't very high till it, and then it picked up and was very strong as the winter started. However, this year started stronger. So you can see the black line even in April and May was at very strong numbers, excess of $50,000 a day. The MR product tankers, on the other hand, had a very, very strong FY23 first 9 months, which has come down a little bit in FY24. And you can see the change in the averages. And again, these are market averages I'm talking about. These are not necessarily our earnings. So what drove this? Just for the quarter, crude tanker earnings were lower year on year. I mentioned that 60,000 came down to 45,000 due to a drop in Middle Eastern exports. However, we also saw counterbalancing impact of increased exports from North and South America. Product tanker earnings were also lower year on year. Again, refining turnaround. So refinery turnarounds in the last quarter of 2023 reduced the amount of product that was... Yeah.
Excuse me, Shiv. May I request you to be a little closer to the mic so that your voice is a bit faint? Yeah, thank you.
Yeah, okay. So refinery turnarounds in the east were reduced the amount of product which was available for export, which led to lesser cargoes for product tankers. Similarly, the Chinese exports came down significantly. Last year, December, that is December 22, saw very high exports from China. This time it was more normalized, and therefore there was less demand for product tankers in the east. However, west of Suez earnings were reasonably strong, also because of the Panama Canal disruption and good product exports out of the United States. Fleet supply has not been very strong. It was only about 2% year on year. Asset prices continue to remain firm because even at slightly lower earnings, these are very strong earnings, and therefore asset prices continue to remain firm at their highest levels since 2008. The order book for crude and product for crude tankers remains exceptionally low at below 5%. Product tankers is a little higher at about 12.5%. However, still quite low considering the fleet profile. Also, some of the product tankers which have been ordered are Aframax-sized product tankers, which can switch between dirty, which is crude carriage, and product carriage, and therefore some of it might actually swing to carrying crude cargoes eventually, depending on which market is strong. Dry bulk, again, last year was not a very strong year. Cape sizes improved during the year in the 9 months versus the 9 months, and thanks mainly to the end of the year being exceptionally strong. So December, I think, averaged something like $30,000 a day, which pulled up the average, or excess $30,000 a day. And therefore, Cape sizes have done better than they did in FY23 first 9 months. On the other hand, the smaller vessels, and you can see the Supramax index on the right, the smaller vessels which had outperformed. So this is unusual. So you can see FY23 9 months, 16,711 average for the Capes, while the smaller size, the Supramax, averaged 21,100. That's a very unusual situation, and that reversed in this year. So it came down to 12,000, while Cape sizes went up to $20,000 a day on average for the 9-month period. So we had a significant increase in ton-mile demand. The fleet supply growth has been only 3%. Chinese imports have been pretty strong, especially in December. The reason ascribed for the strength in December was big iron ore and bauxite imports into China, both of which were long-haul trades. So bauxite typically coming from Guinea, which is in West Africa, and iron ore coming from Brazil, which is again a very long-haul trade. Coal imports also, and we've been saying this for the last couple of quarters, coal imports into China have been at their all-time highs. This was because they had an issue with hydropower generation, so they were running their coal-fired plants more. The order book continues to be quite low at below 9% of the existing fleet. So going to LPG, while our ships are on time charter, the spot market does affect us when we reprice the ships, and it's not necessary that we will stay on time charter only. But let's look at what the spot markets did. So the 9 months of FY24 were fantastic for the spot markets, averaging $100,000 a day. Again, driven by high US exports, especially the US-Asia trade. Now, this US-Asia trade typically goes through the Panama Canal. The Panama Canal was suffering from low water levels because of a weak monsoon, and therefore they reduced the number of transits. When they reduced the number of transits, quite a few gas carriers took the long route for coming to Asia from the US Gulf, resulting in a requirement for more ships, and the market became tighter. So that's what happened, and that's why the markets were very strong. The order book is in excess of 20%. In a historical context, it's a pretty high number. Now, I mentioned already what the order books are. So you have less than 5% order book for crude tankers. You have under 9% for bulk carriers and 12% plus for product tankers. Even 12% is a pretty low order book. Asset price movements, as you can imagine, asset prices have been strong across the board. Dry bulk had a short period where prices dropped a bit from end of December 22 to the middle of 23. However, they have now recovered and are still pretty strong. All other tanker sectors, all of them, the prices are very strong indeed. In fact, for LPG, the prices are at LPG ships, the prices are at all-time highs. Scrapping has been very minimal, as you would imagine, because the markets have been strong. Even though dry bulk was not very strong in Cal 23, still we had very, very minimal scrapping. And remember, this is 0.5 million deadweight on a fleet which is about a billion deadweight. So we are talking about 0.05% scrapping, even in the market which was not very strong. That is dry bulk. Coming to the oilfield services business, Great Ship India Limited. Fleet supply again continues to be restricted. There are, the usual story. There are a lot of assets which are more than 30 years old in the rigs, and there are a lot of cold stacked assets. The order book is very low because there are hardly any assets ordered for the last 7 or 8 years, ever since the market dropped in 2015. Utilization has been improving very gradually. So we saw a flurry of fixing happening in the Middle East. That was in 21-22, and they are still absorbing all the new rigs which were going into contract there. After that, we have been seeing a little bit of a lull. Pricing, however, continues to improve with every pricing which happens for a tender for term business is done at a higher level than before. So typically these are done when you're coming off a 3-year contract. Typically these assets in India are getting priced between 50 and 100% higher than their previous contracts. This is across the board, whether we are talking of vessels or jackup rigs. Looking at broad financials, we have mentioned this before. We had levered up to buy ships, and then now we've levered down because we've had very strong cash flows. we now have $250 million of net cash. That's just in standalone. If you go to consolidated, that's even higher now. Coming to share price to NAV, it's not, while the stock price has gone up quite a bit, you will see that it still trades at a significant discount to NAV. So we are still at 0.75 of the consolidated NAV at today's price, while the price has gone up 3x in the last 2 years. So apart from doing the shipping and oil field services business, we are also socially responsible company, and you can find details of all the good causes that we support on our website, and these are some of those names. Thank you. That brings me to the end of the presentation, and we are happy to take your questions now.
Thank you. We will now begin the question and answer session. To ask a question, please click on the Raise Hand icon tab available on your toolbar or on the Q&A tab available on your screen. You may also post your text questions on the Ask a Question tab available on your screen. Kindly turn on your mic when the operator announces your name. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from Amit Ketan from Laburnum Capital. Please go ahead with your question.
Hi, good evening. Thank you for taking my question. So my first question is on capital allocation. Are you seeing better opportunities for capital allocation than what you have been seeing, say, in the last 3 or 4 quarters? And secondly, for the recent ships that we've purchased, are we still underwriting to, earlier we were sort of underwriting to a 10% unleveraged dollar IRR. Is that the same underwriting criteria we are following, or have we sort of relaxed this a bit?
Yeah, good question. Thank you. Thank you for the question. Your first question was, are we seeing better opportunities for purchasing? Not really. It's not. So in terms of, we are not seeing cheaper prices and cheaper entry points for our purchases. As you can see in the asset price chart, it's not getting cheaper. And therefore it is not, it's not as attractive to buy as we would like. We don't know the returns that can be made, and this 10%, we would have had a much higher degree of confidence at lower prices. These investments are getting subsidized by the sales of older assets. You may notice we bought one bulk carrier and we bought one product tanker, an MR tanker, both of which were bought, and we sold one of each. We sold a smaller bulk carrier and we sold one of our older product tankers as well. What we're doing is capturing the premium. Again, even the older assets have a significant premium. So we are capturing the premium on the older assets and using it to subsidize, in our minds, the new assets that we are buying. So if you look at the new asset by itself, it may or may not provide that return. However, we know that we have de-risked it to some extent by selling off the old assets also in the same market. So that's what we're doing. Again, this is part of modernizing. We had some old assets we need to get out of them at some point. So we said, let's modernize, move towards modernizing our fleet a little bit. That's the whole idea. But your point is valid. These are, it's tough to put a number or with great confidence as to what we can earn on these projects standalone.
Understood. But for any new purchases which are not sort of replacement, are we going to still follow the same criteria as earlier?
Yeah, we'll be a little slow to make new purchases. So it is replacement. These purchases have been done as replacements more than anything. So we'll be slow to make new investments, that is to do growth investments in this market.
Understood. Second question was on the offshore segment. So this quarter's EBITDA seems to be a little bit off compared to what we've seen, say, last 2-3 quarters. Has there been some one-off element here?
That's right. Yeah, that's well noticed. So we had one of our rigs, the Great Drill Charu, came off her old contract, which was at a cheaper price, obviously. She came off her contract. She was off-hired on 1st of November, and for 2 months, little over 2 months, she was undergoing the work required for her next contract. She had, of course, got her next contract at a much higher level. So for 2 months, she was off-hire. And not just off-hire, so that's no earnings for those 2 months. She also had expenses towards getting her ready for the next contract. So both of which sort of was a double whammy to the results. So last quarter's results are not an indicator of what the market is. As you called it, it's a one-off. This will happen from time to time. Typically, you'll have rigs coming off contract, doing work for about 60 days before they go on to the next contract, in which time you will not have revenue and you will have expenditure. So that will happen from time to time. Typically once in 3 years, that will happen to every rig.
Got it. And this rig is now, when does the new contract start?
The new contract has started. We went on hire in middle of January. So she's now on contract at the higher rate, which was a rate higher by about 75% or so.
Got it. And we have 2 rigs coming up for repricing in FY25. I think ONGC has recently floated a tender for 4 rigs. Are we eligible to participate in those?
Yes, we are. In fact, we are for one of the rigs. We have already bid, and the price bids have also opened. The usual procedure is going on. So we haven't got an award yet, but we are in a reasonably good position to get that award. And for the second tender, which has already come out, we are eligible to bid for that contract.
Great. That's it from my side, and all the best for the coming quarters.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please click on the raise hand icon tab available on your toolbar or on the QA tab available on your screen. You may also post your text questions on the Ask a Question tab available on your screen. Thank you. Our next question is from the line of Vaibhav Bajajia from Honesty and Integrity Investment. Please go ahead.
Hi, sir. I hope I'm audible. Can you hear me?
Yes, I can hear you. Yes.
Yeah. Hi. Thanks for the opportunity. So I just have one question. As you said during your presentation that the utilization and rates were for the rigs market and for basically oil and gas assets market improved in last few years because of increased activity in Middle East. Now, we have also seen the recent announcement by Aramco, which otherwise they are going to stop spending on increasing their capacity. So I just wanted to have your thoughts on how this can impact this market on an overall basis. Because this can be a huge impact.
Yeah, thank you. That's a good question. So this question has occurred to us also, and I think there are quite a few analysts who are speculating on it. We don't know how it's going to play out. They've already taken a lot of assets on hire, a lot of rigs on hire in the last, as I mentioned, since 2021. They've been in the market. So presumably those will go on hire. So they've already absorbed a lot of capacity. So even without additional investment, the market is tight. So long as they don't reduce the number, and there's no reason for them to reduce if they're saying that, okay, we're going to go to a certain level. We don't know what their announcement implies in terms of the number of jackups they require. So it's too early to tell what impact it can have. but they've already taken a lot of assets, and presumably those will start working, have already started. Some have started working, others will start working soon.
Got it.
We'll see. It'll play out over the next few months, I suppose. But the
Right.
market is tight enough. We don't need them to take more assets really for the market to get tight.
Correct. But in terms of, can they return the asset? I don't know how the contractual terms work in this scenario.
I don't know. I don't know what are the provisions in the contracts. So I won't comment on it because we don't know what the provisions are in their contracts.
Okay, got it. Understand. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Ashish Upkanwar from InvestQ Investment Managers LLP. Please go ahead.
Yes. Can you hear me?
Yes, I can hear you.
Yeah. So, sir, on the rigs part, you mentioned that the repricing of one of the rigs is at about 75% higher than what it used to be. So, I think we have a couple of rigs coming up for contract renewals. You mentioned one is undergoing a bidding process again. So, what would be the kind of benchmark or maybe just a feeler as to how it would be repriced? I mean, how's the market like now? What should we expect?
The last pricing which happened, and we were not in that tender. So the last pricing which happened, which was awarded also, was 10 to 15% higher than the 175% price that I told you. So there was 100, it went to 175 when we priced.
Okay.
So the last pricing has been 10 to 15% higher than that price. So the market has only got stronger since then.
Okay, fine. So the effect of the repricing should be seen in your subsidy numbers in terms of much better profitability over the coming maybe 12 months kind of horizon.
Not so much in the 12 months. The one rig will have the impact, and it's already having an impact because she's gone on higher. But the other two rigs which are due for repricing in FY25 will get repriced very late in FY25. So it'll be only for a small part of the year. So we are looking at more like FY26 for the impact of 3 rigs repriced at stronger rates to fully filter through the P&L account.
Okay, got it. And just wanted some feeler on how the standalone operations in terms of what you mentioned on the rates, that on a YOY basis for Q3 on an average the rates were lower. So what is it looking like for maybe in January and going into February, March?
So rates across the board are stronger than they were in December. So that's the headline news. For tankers, rates are stronger.
Okay.
That's the headline news.
But if I recollect, last year the rates were pretty strong, right? I mean, even so on a YOY basis, we'll still have a negative impact in Q4.
No, I think they are probably at or higher than those levels, especially for the product tankers.
Okay. Sure, sir. Thank you so much.
Yeah, sure.
Thank you. The next question is from the line of Yash Jain from Ambit Capital. Please go ahead.
Hello.
Yeah, hi.
Yes, so may I request you to use your handset, please?
Yes, sure.
Yeah, it's a little faint.
Hello, is this better?
Little bit, yeah. Carry on. Let's see.
Yeah. So I have a data-related question. What I wanted to know is, since in our presentation we give the amount of change due to rise in fleet value, but can we get a data point where we can see how the fleet value as a percent of NAV has moved over the last 3 years?
Sorry.
Sorry to interrupt, sir. Your audio was not clear, sir. Could you repeat your question using your handset, please?
So yes, let me tell you what I gathered. What you want to know is over the last 3 years, how much of the NAV growth is due to increase in fleet value?
Yes, right.
Yeah. Okay. We'll need to work that out. So maybe we can connect on that.
Okay, thank you.
I think we have mentioned this for the last couple of years. We've been putting this slide in. So I think this is just a summation of all those. But yeah, we can look at it.
Thank you. Our next question is from the line of Shreyans Gatani from SG Securities. Please go ahead.
Hi, am I audible?
Yeah, hi.
Hi, so my question was actually on scrapping. So the last year or two, we've just seen very low scrapping levels. At some point, you know, ship owners will be forced to scrap as the ships, age. So just wanted to get your outlook on, when we expect, some scrapping levels to go up.
Yeah. Thank you. Good question. So just one thing I'd like to correct you. You're never forced to scrap because of age. You are only forced to scrap when your vessel becomes too expensive to operate, or your vessel is not acceptable to customers, to a large number of customers, and therefore you're not able to earn enough revenue to keep the vessel going. There is no statutory drop dead date for vessels. Okay. Now people are starting to put in. So I'll caveat this a little bit. Now individual flags are starting to put in restrictions on the age of ships, but that is quite a liberal. So for instance, you can operate a crude tanker till 25 years of age. Typically beyond 20, it becomes a little difficult to operate, a little less acceptable in the market. So, but you can still run it till 25 years of age. So only at 25 you may be forced to scrap or sell it to somebody whose flag permits them to operate beyond the age of 25 also. Scrapping is typically a function of, as I said, when it becomes too expensive to continue to operate and you're not able to recover the continued cost of operation from the revenues that you're likely to earn. Currently, the scenario is that you're making enough money to even run very old ships. So you can continue to run the ships so long as the market remains like this, and it doesn't have to be very strong. This is a very strong market. Dry bulk market was not very strong, and you saw last year's averages, they're not huge. But with those numbers, you can make a living and you can continue to run your ships. So what you need for scrapping is a weak market, or if a large proportion of customers do not accept vessels beyond a certain age or for whatever reason, let's say not well maintained ships. That's the only trigger you can have for scrapping. If you're looking at age, there are already a lot of ships which are above the age at which you would say this ship needs to be scrapped. For instance, we take 20 as the age as the useful life of a crude tanker. But a significant proportion of the fleet of crude tankers is beyond the age of 20. So they are still operating. It's not an issue so long as you're able to get employment for the ship and you're able to run the ship at a reasonable cost.
Got it. That's very helpful. So just a follow-up. So what would be like, for example, crude product and dry bulk, like, certain break-even levels where, like, for example, you mentioned 20 years for crude. So what would be prices that would, force people to, increase their scrapping level?
So the other thing here, and again, this is, I may have oversimplified it a little bit. We had a very weak market, and you may remember it in calendar 21. Post COVID, from second half of 2020 and through calendar 21, the tanker markets were exceptionally weak. In fact, we had the weakest tanker market of the previous 30 years. It was weaker than we had seen for the previous 30 years. And still scrapping was very, very, very minimal in calendar 21 as well. So it's tough to put a number on that, but One, if you have a very weak market, earning just about OPEX, or you have a very large expenditure coming up on your ship, you may think of scrapping it. There are also some environmental guide regulations which have kicked in from this year, which is with regard to the fuel efficiency of the ship, which may push some ships into being forced to scrap. Again, if the market is strong, nobody will be forced to scrap because the customer will take the ship. If the customer needs the ship, they will take the ship. Otherwise, there's going to be a shortage of ships. If ships get scrapped irrespective of a strong market. So there is no number. But if you have a repeat of calendar 21 in terms of earnings, which were just marginally above operating expenses, then you could have some scrapping, but even that is not a given. You need at least that in order to kick scrapping off in a big way. And last 8 years have seen minimal scrapping in tankers.
Right. Yeah, that's why my question came in. So, that is the basis of my question. That's very helpful. Thank you.
Sure. Thank you.
Thank you. The next question is from the line of Devesh Chawar, who is an investor. Please go ahead, sir.
Yeah. Sir, my question was regarding the issue at Red Sea. The current tanker rates are inching close to in some of the routes they are inching close to $100,000 a day. So, and you were also mentioning earlier in this call that the tanker rates are strong and they are close to where they were in Q3 FY23, if I'm not wrong. So, do you think this is just a temporary blip that can reverse back in a quarter's time, or this can stay for longer? Just not a permanent statement, but what's your view on it?
This is geopolitics. Nobody knows what's going to happen tomorrow or even this evening. So we just don't have a comment on it. It was unexpected when it started, and who knows what will bring it to a stop.
So, sir, for now, the ton miles are going off and they are not coming back as of now.
As of now, yes. As of now, transits have dropped significantly through the Suez Canal.
Okay. Thanks.
Thank you.
Thank you. Our next question is from the line of Archon Pathak from Centra Insights. Please go ahead. Mr. Pathak, you can go ahead with your question. Mr. Archon Pathak, may I request you to unmute your line from your side, please? Whereas there is no response, may I request that we move to the next participant?
Yes, please.
The next question is from the line of Vaibhav Bajatia from Honesty and Integrity Investment. Please go ahead.
Hi sir. Thanks for providing the opportunity. So when we are showing that different value of our asset, so I'm sure all of our assets will be of different vintage. Some will be 11 years, 12 years, 13 years old. So is the valuation of these assets based on exactly the same vintage, or it is like we take like for 10 to 15 years of age, we take the 15-year-old asset value and then include it in our asset value? How does it exactly work?
Yeah, the valuation of the ship is for the specific, not just the same vintage, it is for that specific ship, taking into account all the conditions around that ship. So this is not our assessment. This is an assessment by two brokers, ship brokers, who do give us the assessment, their assessment of the value of the ship, and we take the average of the brokers. And sometimes we use three brokers also.
Okay.
So this is their assessment of the value. This is not our estimate or assessment of the value.
Yeah, I understand. But yeah, it is exactly for this specific ship.
That is right.
So that's what okay, got it. And that's it from my side. Thank you.
Thank you.
Thank you. Our next question is from the line of Himanshu Upadhyay from O3 PMS. Please go ahead.
Hello. Good evening. Am I audible?
Yes, you are.
Yeah. My question is regarding what we stated about replacement. Okay. So the first query here in this call also and the last one also. See, one of the observations was in last 5 years, whatever ships we have acquired have been generally 10-year-old. Okay. From 2018 onwards. Okay. And generally we want to means crude carrier product, and we are outside India or operating most of our ships outside India. Where generally clients don't want to be in ships beyond 16, 17 years. Okay. And then we need to replace them or find some other opportunities for them. And again, if we are buying 10 years, so what we are having is only 5 to 6 years of ability to charter those ships. Okay. So that is one point. And the second is generally, let's say this market goes.
Himanshu, you're breaking. I've lost you.
So Himanshu, we are unable to hear you. May I request you to unmute your line from your side, please? We have lost the connection for Mr. Himanshu. We move to the next question. Our next question is from the line of Roshan Nair from B&K Securities. Please go ahead.
Thanks for the opportunity. So I just wanted to understand that is it fair to assume that the day rates that we have for Q3 doesn't capture the rising day rates because of the Suez Canal issue? Is it fair to assume that this quarter hasn't captured any of those impacts?
That's right. Because that happened only late in December, and it more like January actually, where the serious rerouting started.
Right. And another question that I had is on the offshore support vessels. So close to 9 vessels were about to be repriced on this quarter. So has it been done, and is it at the higher rates that was versus the previously contracted rates?
Yeah, in India, all the rates have been between 50 and 90% higher. These are typically 3-year contracts. So between their last 3-year contract and the current 3-year contract, a few of the vessels are operating overseas, which had already got an improved pricing. But even there, the pricing between beginning of last year and that's beginning of 1 year ago and say 3 months ago when they repriced is up by at least 20 to 25%.
Okay, that was helpful. Yeah, that's all from
every repricing is happening at a higher level than the previous. So that's the broad message.
Okay, that's helpful. Thank you so much.
Thank you.
Thank you. So we have a text question from Ashish Gautam, who's an investor. I will read out the question to you. Could you throw a light on the current pricing scenario, especially in the product tankers market? And also, what % of fleet will take advantage of the sharp rise in the prices? Do we expect Q4 to be the best quarter of the year? Congratulations on the consistent performance.
Yeah, thank you, Ashish. The current pricing is at very strong levels. I mentioned that earlier. Again, it's sometimes location dependent. In December, the MR product tanker in the west was much higher than the product tanker market in the east. So when I talk about what the current pricing scenario it is across all regions, sort of an average. It is a very high. They're very strong rates. So if you had to put a number, you would be talking of $35,000 to $40,000 for a product tanker, an MR tanker, and larger product tankers are doing much better than that. Typically, 75 to 80% of our fleet, tanker fleet, is operating on the spot market and is therefore in a position to take advantage of the rise in freight rates in the tanker market. Again, there may be leads and lags, because if you're already on a voyage, you can only reprice after a certain amount of time when the next voyage is to be fixed. As to whether we expect Q4 to be the best quarter, we don't give guidance. We don't know also whether it's going to be the best quarter of the year, because we don't know what rates could be tomorrow when we go to fix our ship, the next ship. So yeah, and thank you for the question.
Thank you. The next text question is from Yash Jain. How has the fleet value as a percentage of NAV moved over the last 3 years?
Yeah, we will. Yeah, I think Yash asked the question in person when he spoke also, so that we will look at, and it'll be there in the previous presentations, and we can.
Thank you. Yeah. We have a text question from Shivan Sarvai from Univiction Investment Advisors LLP.
Yeah, I can see the question. The repricing schedule, one of the VLGCs. So the question was on the repricing schedule of the 3 VLGCs. One of them has already got repriced. She's just gone on to a new contract at a significantly higher rate than the previous one. The other 2 will be repriced somewhere between March and June of this year.
Next text question is from Rajesh Khattar, who's an investor. Why has Mr. Bharat Sheth not been joining the recent calls? Earlier, he used to join every call. Going forward, over the next 2 to 3 years, how much percentage will your offshore business contribute to your PAT?
Yeah, on the first question, yeah, it's a matter of choice that he has decided not to join the calls. He is busy with other things, and therefore he is not joining the calls. I hope we are able to answer your questions sufficiently, though, because we have the team available to answer your questions. And going forward, we don't know this number, because we don't know what our PAT will be in the first place, with 75 to 80% of our fleet in the spot market. So we don't even know what the PAT will be. We don't know what the repricings will be. So I won't be able to answer the question, how much but the contribution should increase, because till a year ago, there was no contribution coming from the offshore business. They were going through a very bad market. Now that market is improving, so progressively it should improve. That's a broad takeaway we can have.
Thank you. The next question is from Pritesh Chheda from Lucky Investment. In segment finance, the offshore assets has insignificant ROIC. With all the repricing of assets in OSV plus rigs, will the ROIC rise 15%?
So again, this is a forecast. We are not going to make forecasts, because again, we don't know what these numbers could be. The next repricing could be. A lot of it is tender-driven business. It depends on the competition and specific tenders. However, when the market was strong, and the strongest year we had was 2015-16, the ROIC was well in excess of 15%. That's all I can say, that it can be in excess of 15%. The rates might be different from what they were at that time. Cost structures can be different, but that's all we can say, because we don't know what next year's profits can be, because we don't know the pricings that we can have.
Thank you, sir. We have an audio question from the line of Archan Patak from Centra Insights. Please go ahead.
Am I audible now?
Yes, sir. Please go ahead.
Okay, thank you. So my question is regarding our offshore segment. Like when I was trying to find the offshore revenue for this quarter, which is the difference between the consolidated and standalone, it comes around 200 to 250 crores, right? So on a yearly basis, if I assume it to be 1,000 crore revenue, and now with large part of our fleet, getting repriced in the next year at 50 to 60% higher prices, would it be fair to assume that the hike in the top line will be equally passed in the bottom line? So we can say that an additional cash flow of 400 to 500 crores by repricing can come in our balance sheet?
When all the assets are repriced, so again, it's important to understand that the assets don't get repriced all at the same time. I mentioned the repricing schedule. 2 rigs are getting repriced late FY25. So we will have 3 rigs repriced into the new rate in FY26. So, but yes, your broad question on the repricing and the impact on the bottom line, because the cost base is reasonably fixed except for normal cost inflation. So it should translate into bottom line impact. Net of tax, there is tax payable on the drilling business, so you have to take out a tax and then it should translate.
Okay, got it.
Yes,
That's all from my side.
Translate to a reasonable contribution.
Okay, thank you.
Thank you. The next question is from the line of Forum Makim from JHP Securities. Please go ahead.
Hello, sir. Just wanted to know if the current situation at Red Sea affects our fleet utilization at the moment.
It doesn't affect the utilization. So it doesn't affect the utilization of the fleet. In the sense, the global fleet utilization has gone up because ships are rerouting around Africa to go from east to west. But it's not affecting our fleet utilization.
Okay, and we would be able to take advantage of the higher prices, right?
Yes, because rates, the next time we fix, we will also get the benefit of the higher price. The next time we fix for a void, we will get benefit of higher prices.
And are the rates higher than the FY23 rates that we saw like last year?
You mean current rates? Are they higher than the year ago rates? For product tankers, yes. In fact, they are at the highest levels since that 1 month, which was when COVID hit, and there was a huge storage demand. For product tankers, rates are higher than that. Crude tankers still very high and probably getting close to the rates of last year.
Okay, thank you so much.
Thank you.
Thank you. Our next question is from the line of Himanshu Upadhyay from O3 PMS. Please go ahead.
Yeah, hi. My line got dropped out. So again, I'll repeat my question. See, the question is on the fleet renewable. Okay. One of the observations which
you mentioned that ships become less marketable after 16 or so, and therefore, we don't get much time if you buy 10-year-old ships. That broadly was your question, if I remember right.
And again, the price of the older ships falls much sharper. Okay. Means that, again, let's say 3-4 years down the line when the cycle goes down. So so if we, let us say, do the back testing, okay, that in 2005, 6, 7, 8, means we would have replaced our 20-year ships, not with new, but let's say this 10-year-old ships. How would it have done, let's say, 2015, let's suppose 8-9 years, then what strategy you followed in the last cycle? And some thoughts on that and working of IRRs.
Yeah. So first, on the marketability and tradability of ships, it's not just on the age, it's on how well you maintain your ship. So we have found that our ships, and we are running our MR tankers, we have quite a few ships which are 18 plus years of age. Okay. We are able to trade them worldwide. So these ships are trading worldwide. So there is not much restriction in their tradability because we ensure that they are maintained to the standards required. So it's not just, this age and knock off. Okay, so that's one. Some customers will say beyond 20, I can't take it. Some terminals will not accept, etc. But that is at 20, not at 16 or 17. Second, coming to the past. So in backtesting, and it's interesting that you should mention backtesting because that is exactly what we looked at. So in backtesting, you will find that the 10-year-old ship will give you a better return than a more modern ship. And in these old ships, typically what you're doing is you're earning in a hot market. So in a strong market, the differential in earnings between let's say a 17-year-old ship, which is worth, and let's say for an MR tanker, maybe worth $18-20 million, and a 12-year-old ship, which may be worth $32 million. Just giving numbers as an example. The differential in earnings is not much, unless one of them is eco, in which case then you have to pay a premium for that eco also. The differential in earnings in a strong market is not much between these ships. We saw this actually in the boom, where we had bought single hull tankers, and we got tremendous bang for the buck for buying those ships because you could buy two for the price of one 5-year-old ship. And so you made twice the earnings on buying those cheaper ships. Obviously, those were 15-year-old ships, and that was a little even more extreme. So in backtesting, you do best if you buy older ships, even 15-year-old ships. Obviously, we will not buy too many 15-year-old ships. But 10-year-old ships work perfectly fine. They are acceptable for at least 8 years after you buy them for a tanker. And they give you very good cash flows, which enables you also to reinvest in the business because they are producing such significant cash flows as a proportion of the capital employed in that ship. Again, we are not going to only go with 10-year-olds. Don't get me wrong. We may buy even younger ships. And last time we bought, actually, the crude tankers we bought 5 crude tankers in 2016-17. Of those 5, 4 were between 5 and 7 years of age. Only one was an older ship, which was actually a 17-year-old ship, which was available very cheap. But we actually bought between 5 and 7 years of age. So while in an Excel sheet, it looks great to buy a 10-year-old ship, but we will not be restricting ourselves. If we get a good ship, which is a little bit, which is 7 years old or 6 years old, we'll buy that also at a good price. Himanshu, are you there?
Sir, the line for Mr. Himanshu has dropped. We move to the next question. Next question is from the line of Roshan Nair from B&K Securities. Please go ahead.
Thanks for the follow-up. So I just wanted to understand how are situations panning out at Panama Canal. It still continues to be a key driver for higher day rates across the globe?
Actually, the Panama Canal situation has got eased a little bit. I think maybe the fact that Suez Canal transits were reduced, maybe some pressure was there on them. They have not dropped. They were going to drop to, I think, 20 transits or something like that, but they are still at 20 to 24 transits per day. So it's currently the LPG market, and again, also because LPG trade has not been very strong. So LPG market has dropped off, but that's not because of the Panama Canal. But Panama Canal transits have picked up slightly in the last month or so. They announced that they're going to relax and have more transits. But yeah, the water levels have not increased. Ideally, the water levels should be 85 plus, but now it's still at 81 or 82. It's recovered a little bit from 81 to 82. But they are permitting more transits currently.
Okay. That's all from my side. Thank you so much.
Thank you. Our next question is from the line of Anuj Sharma from M3 Investment. Please go ahead.
Hello.
Yes, sir, please go ahead.
Yeah, hi. Sorry, my connectivity was intermittent, so pardon me if I'm repeating the question, but what is...
We've lost you.
Mr. Anuj Sharma, we are unable to hear you, sir.
Yeah, am I audible now?
Yes, sir, please go ahead.
Yeah, I was just trying to understand how is the capacity evolving at the shipyards and how do you...
Yeah, so I hope you're still there. Hello.
Yeah, I'm there.
Hello.
I'm there.
Yeah. Okay.
Yeah, I'm
So the
there.
capacity at shipyards there's not much capacity available to produce ships in the short term. So I think we are 2024 and 2025 are fully booked. I don't think you can find a slot there. Basically, all of this is got booked building LNG ships and container ships. So it's not really available for conventional tankers and bulk carriers. In fact, there was a report which said that there are hardly any slots available even in 2026 for building large crude tankers. So capacity is still quite restricted for ordering new ships. So in the foreseeable future, there is unlikely to be a significant amount of new supply of ships into the market, into at least the dry bulk and tanker sectors. So it's not that any large amount of capacity is getting added, if that is the question you're asking.
Yeah. And just a corollary, we see some capacity, some order book rise in the product tanker market. Anything to read into that?
No, it's in fact, even the crude tankers have seen quite significant ordering in December, but it's still a pretty low order book. So it's been building up, but 12% order book for product tankers is not that much. And if you just take tankers as a whole, I mentioned earlier that a lot of the product tanker orders are Aframax size ships, which are called LR2s. So you build them with the coating so that they're able to carry product, but that can actually swing between the crude trade and the product trade. If you take the entire tanker order book as a whole divided by the tanker fleet, we're still talking about 6 to 7% order book really. So not a huge number.
All right, Chief. Thank you so much. Thank you.
Sure. Thank you.
Thank you. We have a text question from the line of Gaurav Chopra from Lemon International. How do you see the freight rates trajectory in next 1 year looking?
We don't give outlook because, and the main reason is that we don't know what these rates can be. So we don't give an outlook on the freight rates.
Thank you, sir. The next question is from Abhishek Nigam. What is the amount of the one-off expenses booked in offshore in this quarter?
Yeah, the amount was little above 40 crores, about $5 million, Abhishek.
Thank you. The next question is from Anil Thakkar from Jalanch Advisors. What is the bifurcation of contracted ships versus spot ships in your fleet?
Yeah, typically about 80% of our fleet is running on spot or spot related rates. Contracted is 20% or less of the fleet.
Thank you. The next question is from Forum Markin. Does the Red Sea situation...
This question was already taken on the voice call. Yeah. And I think the next one also was taken from Achal. Yeah.
So the next question is from Rajesh Kattar, who's an investor. Rephrasing my question, if the average freight across all ship categories by and large...
Yeah, so this one is like too much of a hypothetical, but because all of these rates we don't know how much they're going to. When we're talking about rigs and vessels, how much the repricing could give a bump up in the results, we don't know those rates. So it's impossible to give an answer to that. We don't know what the number could be.
Thank you. The next question is from Vikram Suryavanshi from Phillip Capital. What is dry docking schedule in fourth quarter FY24?
I think we have 2 or 3 vessels being dry docked, and some of these can spill, 1 month here and there. So 2 to 3 ships being dry docked in this quarter.
Thank you. The next question is from Himanshu Upadhyay. Are we looking for opportunities for offshore support vessels outside of India, as generally the rates are high there and we are seeing 2-year contracts being signed? How many offshore support vessels will be outside India?
So out of our 19, we have 5 vessels currently outside India, if I'm not mistaken. And yes, we will look for we always look for opportunities whenever vessels come up for pricing. We look for opportunities. Some of the vessels are more suitable for some regions, so there are some limitations there. But we do actively look. We have a marketing team which is capable of marketing internationally, which has relationships with customers overseas. In the last year and a half, we have taken 2 vessels out of India. So yeah, we are always looking for opportunities. But it's rare to get 2-year contracts outside India.
Thank you.
Yeah.
Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Ms. Anjali Kumar, Head of Corporate Communications and Finance, for closing comments.
Thank you very much, everyone, for that really engaging session. And I do realize that we had a lot of forward-looking questions, which, as you should understand, in our business is very difficult for us to, make any calls beyond the very, very near term. However, please do keep engaging with us and reach out to our team with whatever other queries you may have, and we will be very happy to meet with you. And the transcript of this call will, of course, be uploaded very, very shortly. Thank you, everybody, again for joining.
Thank you, everyone.
Thank you. Ladies and gentlemen, that concludes this conference call. Thank you for joining us, and you may now exit the meeting.